Okay, let's continue with our lecture on swaps. And if you remember the last lecture, we looked at, we had a list of 6 different swaps, starting with the credit default swap that we studied towards the end of the lecture, and then the 5 other swaps, which is the plain vanilla swap, the rate anticipation swap, the intermarket swap, combination swap, and the currency swap. Okay, now, and I explained how in each case you define the swap and then explain the conditions under which you would execute such a swap. Okay, now understand swaps are extremely important from a speculative perspective, and hedge funds use them quite a bit in trading. And we discussed some specific examples. For example, the how swaps, credit default swaps were used, during the housing crisis, or we saw the credit default swap rates during the housing crisis for Lehman Brothers, Bear Stearns, and Goldman Sachs go up all the way to 7.5. I explained how credit default swaps for Greece and Germany could have been employed to come up with a very profitable strategy after the housing crisis, but before the sovereign debt crisis. And then I explained how the swaps between for investment grade and high yield bonds, and these swaps have a particular name. Let me put that down over here in this corner. It's the CDX, CDXIG, and CDXHY. Those are the swaps on a portfolio of investment grade and a portfolio of high yield bonds. These are over-the-counter swaps, so you have to find an over-the-counter market to trade them. But there are several ways institutional traders can trade them. I discussed how you could have followed a strategy just at the beginning of this COVID-19 crisis of taking a long position in high yield and a short position in the investment grade swaps and making a lot of money. So those are some examples of how you use swaps. But I want to spend a little time on the plain vanilla swap. And there's a nice example in the text showing how you use that from a speculative standpoint too. Now, the plain vanilla swap is a standardized swap, very heavily traded. It's used for speculative and hedging purposes. So let's look at what the definition of the swap is a little more carefully and see how you use that from a speculative standpoint, tying it into our macro analysis. Okay, so the example I want you to look at is on page 153, figure 7.1. So we have a swap between, this is the plain vanilla swap. And this is between Microsoft and Intel. Okay, so we have Intel over here. We have Microsoft over here, right? And I'm going to put the terms of the swap in red, where we have LIBOR over here, we have 5% fixed over here on a nominal amount of 100 million. Okay, and this is a 3-year swap. Okay, so all the details about the swap are defined in red. They characterize the terms of the swap. Okay, so look at it. This is pretty much like a bond. When we talk about a bond, we give it the par value and the coupon rate and the maturity. That's the par value, coupon rate, and maturity. Okay, so that'll give you some idea of how the cash flows from the swap are swapped. So the terms of the swap are as follows. It's written on a par value of 100 million, where Microsoft pays Intel 5% of the par value annually, but paid semi-annually like bonds, and Intel pays Microsoft, the LIBOR rate on the swap. The LIBOR is a variable rate that changes. So the LIBOR rate on the swap of 100 million over 3 years, paid semi-annually. Okay, so now let's put the cash flows to this swap up. And this is illustrated in table 7.1. Okay, so we can look at this either from Microsoft's view or from Intel's point of view. But I'm going to set up the timeline over here. So this is 0, 1/2, 1, 1.5, 2, 2.5, 3. So that's a 3 of 6-month intervals. Okay. And so let's look at this from Microsoft's point of view. Microsoft pays. Okay, so this is illustrated in table 7.1. So Microsoft, we're looking at this from Microsoft. So Microsoft pays 5% of 100 million to Intel. So 5% of 100 million is 5 million, paid semi-annually. So that's 2.5 million minus 2.5. The minus sign, this from Microsoft's point of view, it's paying. Okay, minus 2.5, minus 2.5, minus 2.5, minus 2.5, minus 2.5, minus 2.5. Okay, and it receives LIBOR. Now the LIBOR rate, remember, varies. Now we know the LIBOR rate initially, it's given by 4.2%. So I'm going to write the LIBOR rate in green over here. So that's the LIBOR rate. And it varies, right? I know it at time 0, the time you get into the swap. And that determines the cash flow that Microsoft receives. So Microsoft pays. So M, Microsoft pays. And this is M, receives. Okay, now the first thing is the LIBOR rate at time 0 is 4.2, and therefore it receives the LIBOR rate, 4.2% of $100 million, paid semi-annually. So it receives 4.2 million divided by 2.1 million. Okay, now the LIBOR rate changes with time. Now I'm going to put the changing LIBOR rates in a different color. Okay, and the textbook says that as the LIBOR rate changes, what are the rates there? 4.8, 5.3. So let me write them down. So 6 months later, it's 4.8. Then it's 5.3. And it then becomes 5.5. These are all percentages. 5.5, 5.6%, and 5.9%. Now, why do I put them in different colors? Because at time 0, if I'm standing over here and I'm looking at the swap terms over here, I know the LIBOR rate today. I know the terms of the swap today. In other words, I know all the cash flows that Microsoft will be paying, right? Because Microsoft pays 5% of that, and it'll be receiving the LIBOR rate. But at time 0, I only know 4.2%, the LIBOR rate over here, and I know this percent. Now, in 6 months, the LIBOR rate will become 4.8, in which case this will become 2.4 million, because 4.8 of 100 million is 4.8 million, and payments are paid semi-annually. So half of that is 2.4 million. Then the LIBOR rate, I put it in red because at time 0, I don't know what this payment is. I'll only know this payment at time half, because the rate is set at the beginning of the period and the payment is paid at the end of the period. So then it's set to 5.3, and Microsoft will receive 2.65. These are all millions. And then it hits 5.75, Microsoft receives 2.75. Here Microsoft will receive, when it hits 5.6, Microsoft will receive 2.8, and when it hits 5.9, Microsoft will receive 2.95. Okay, so those are all the cash flows. Now, so let's look at the net cash flows. So let's calculate the net to Microsoft. Okay, first it's a negative cash flow. So let's net this out period by period. This is minus 0.4 million. Then it becomes minus 0.1 million. And then it becomes plus 0.15 million, plus 0.25 million, plus 0.3 million, plus this is 0.45 million. So those are all the net cash flows. 15, 25, 30, 45. Okay. Okay, now we have, so what happens is this whole layout over here is a diagrammatic representation of this swap that I have over here. The swap is defined by this stuff in red. 100 million swap fixed for LIBOR and a 3-year. And these are the corresponding cash flows. But remember, in laying out these cash flows, the initial LIBOR is what I know. The subsequent ones I get to know over time, which then determines these cash flows. So we're looking at one particular path of this. Okay. Now, let's calculate. So these are the net cash flows to think, right? Okay. Again, what I should have done was put all of these in red, because I'm not sure what they are. So let me put this as minus 0.1 million, plus 0.15 million, plus 0.25 million, plus 0.3 million, and this is plus 0.45 million. Again, why do I put these in red? Because the first cash flow I know with certainty. The future cash flows depending on what LIBOR rate turns out to be. Okay. Now, the question is this. So let's look at how, from Microsoft's point of view, how you value this swap. Okay. Now, remember, Microsoft and Intel will only get into this swap at time zero is if it's a fair deal. Okay? Because there's no money changing hand. We're just agreeing that we'll execute this swap on these terms. And both sides are agreeing at time zero, right? That means when they agree to it, it means neither side is expected to make money or lose money from this swap. It's a fair deal. In other words, the value of the swap at this point in time, the value of the swap should be equal to 0, where the value of the swap is defined as the present value of these payments. Okay, so from Microsoft's point of view, getting into the swap results in these net payments. Okay, also the value of the swap when Microsoft gets into it should be 0, because why would it get into a contract if on some net present value terms it was losing money? And if it were losing money, Intel would be gaining money. Of course, if Microsoft on average was making money, it'll be happy to get into the swap. But on the other side, Intel would have to get into it expecting to lose money. Why would it get into it? So you won't get both parties agreeing to a swap unless both parties are getting a fair deal, in which case the value of the swap should be 0. Okay, now remember, you can value a swap the same way you value the cash flows to any project. The value of any sort of security is the present value of expected future cash flows. So it should be the present value of these cash flows. So the present value of those cash flows should be 0. Of course, it's a little tricky because the red numbers, I don't know until later on. But I do know the first number. So I want you to look at this from Microsoft's point of view, all right? That its first cash flow is negative. Also, the present value of all these cash flows should be 0, right? So we have two conditions met. I'll repeat it. The first cash flow is negative, and the present value of all these future cash flows should be 0, right? What does that say about the future cash flows? What it says is this: if the first cash flow is negative, at some point over this 3-year contract, the cash flows must become positive. If they don't become positive but remain negative, we know the value of the swap can never have a present value of 0. So in other words, the cash flows must switch from negative to positive at some point in the middle of this 3-year period. And we know it has to be somewhere in the middle, because if it's negative for a while and it's positive for a while, then the net present value of that has to be 0. So in other words, it can't get too positive too quickly, and it can't get too positive too late, right? So it's somewhere in between that period. Okay, what that means is we know it's supposed to get positive sometime halfway during that period. And when they do get positive, these become positive. That means these exceed 2.5. So if these become positive, it means the variable rate payments exceed the fixed rate payments. For the variable rate payments to exceed the fixed rate payments, the LIBOR rate has to rise above the fixed rate. So let me summarize the gist of all of this. It means this: if I see a swap with this term for a 3-year swap, right? And the current LIBOR rate is 4.2. What this swap is telling me is sometime halfway through the next 3 years, the variable rate LIBOR has to start at 4.2 and exceed 5%. That's the expectation. Okay? So that's what this swap is telling us. That's the market consensus expectation of how interest rates are changing. The market consensus expectation must be that the LIBOR rate is currently, we've observed it to be 4.2%, and the market consensus expectation is sometime halfway between now and the end of 3 years, we're expecting the LIBOR rate to rise and rise above 5%. Notice that's quite a remarkable result, because all we're doing is we're looking at this swap, 5%, right? And the LIBOR rate currently is 4.2%. And that tells us a story. And the story tells us instantly, since this is a 3-year swap, is we're expecting LIBOR rates, variable rates, that start at 4.2 to exceed 5 sometime halfway through the 3-year period. Now you can do your macroeconomics analysis, put that cap on and ask yourself, well, if the current LIBOR rate is 4.2% and it has to rise above 5% over the next, it should hit 5% over the next year and a half or so. Okay, you have to ask yourself, well, is that a reasonable expectation, right? So what's the macroeconomic environment? Is the economy growing? Do we expect the Federal Reserve to raise interest rates rapidly? Default? So you do all your macroeconomic analysis and ask yourself, right, if rates are to rise from 4.2 to 5 over the next year and a half, it means, notice you can go back to the Fisher effect equation, right? We're expecting inflation to rise by about 0.8% over the past year and a half, over the next year and a half, right? Because if inflation goes up by 0.8%, then interest rates will go up, nominal rates will go up from 4.2 to 5. Okay, so the question is, do you expect inflation to rise by 0.8% over the next year and a half? You can ask that question, right? Then that's what this is saying. And then you do the macroeconomic analysis and say all the macroeconomic data says, no, we don't expect inflation to rise. Okay, that's your private analysis. What do you conclude if you expect inflation not to rise? That means you expect the LIBOR rate to remain low. You expect all these LIBOR rates to remain low, right? You expect all these cash flows to remain close to 4.1, and you expect all these cash flows to remain negative. In other words, your analysis is, if you were advising Microsoft is considering going into this swap, right? And Microsoft seeks your advice. Should I get into this swap? Right? What you will tell Microsoft is as follows. This swap suggests that inflation is going to rise by 0.8% in the next year and a half. You'd advise them that the macroeconomic analysis points does not support that, your own macroeconomic analysis. And if you expect inflation to remain about the same, you would expect LIBOR rates to remain about the same, and you'd expect Microsoft to get all negative cash flows over here. In other words, this would be a terribly losing position from Microsoft's point of view, right? And therefore, would you advise Microsoft to take this position? No. So as a consultant, you could do that. On the flip side, suppose you came to that conclusion, right? You would like to take this swap, but not on Microsoft's side. As a speculator, you would be on this side of the swap, on Intel's side of the swap. Why? Because what would happen is, on Intel's side of the swap, Intel, while Microsoft is losing money every year, on Intel's side of the swap, you'd be making money every year. In other words, this is a project that requires you to put zero investment down, and you get positive cash flows every year for the next 3 years. Does that sound like a good deal? Okay. So, by looking at the terms of the plain vanilla swap, summarizing this, by looking at the terms of the plain vanilla swap, right, inferring what they mean about which way interest rates are going, and from that, inferring about what it means about inflation expectations, right, and matching that up, that is the market consensus inflation expectation. That's what these tell us, right? The fact that we're expecting LIBOR rates to rise means we're expecting inflation to rise. It means that's the market consensus expectation of expecting inflation to rise. And your private expectation, based on the macroeconomic analysis I taught you to make, you would conclude, I don't expect inflation to rise. That results in a trading strategy as to which side of the swap you want to be. Are we okay with that? Okay. So now, what I'm going to do is take this one step further. Okay, so that's all that we're going to do with respect to swaps from a speculative standpoint. Now I'm going to switch a little, right? Remember I told you we're going to look at swaps from 3 perspectives. From a speculative perspective, from a hedging perspective, and a valuation perspective. So now what we're going to do is we're going to look at the same swap from a hedging perspective. So let's do that. Let me erase some of this stuff. I'll keep the swap over there. It's just these cash flows I don't need. Okay, now let's look at this swap. Now, I could, strictly speaking, this particular swap, which is called a plain vanilla swap, has 3 years to maturity. Okay, now, we have different maturity swaps, all the way up to 7, 5, 7, 10 years, it varies, right? So you could have a plain vanilla swap with 1 year to maturity, 2 years to maturity, 3 years, 4 years, 5 years, 6 years, 7 years. Okay? In fact, if you go to the Federal Reserve website on historical rates, constant maturity, just do a search at under HR 15 or something like it, the Federal Reserve historical, where the Federal Reserve posts treasury rates. It'll also post swap rates with different maturities. So these swap rates are standardized contracts, and you can get the rates for different maturities virtually every day for free. Okay, so let's see. Now what I can do is I can plot this over here. I can plot the swap rate versus maturity. And for 3 years, it's 5%. Okay. So what's usually standardized for swaps is the face value, right? If this is a swap that's most standardized swaps are have a face value about 10 million. But notice over here, one leg of the swap is always LIBOR, so you don't have to say that we have LIBOR on this side. It's always LIBOR on this side. The only thing that varies for different maturity swaps is the fixed side, right? So for a 3-year swap, we say the swap rate is 5%. So when we say the swap rate is 5%, what we mean is the fixed side of this swap is 5%, right? And we say it's a 3-year swap. It means we're swapping out cash flows for 3 years. And the face value is usually standardized. So the only two parameters that you need to completely specify the swap is the maturity of the swap and the fixed rate side. So it's like a bond. We specify the maturity of the bond and the coupon rate. The face value is standardized. Okay? Okay. So we have now similarly you can have the 2-year rate, the 1-year rate, the 4-year, 5-year, 6-year rate. So it could be something like this. And these are all markets. This plain vanilla swap is a standardized contract. These are all market rates. Okay, so you can get all these rates. I told you they're posted on the Federal Reserve's site, and the curve through all these is called the swap curve. Okay, so the swap curve is interesting because look what it says. If this is 5%, right, we're expecting interest rates to go from 4.2. Remember, the LIBOR rate initially was 4.2. We're expecting it to exceed 5% in 1.5 years. So you can reach similar conclusions about all these, and that gives you a more comprehensive picture of the market consensus expectation of how we expect inflation or the LIBOR rate to change over time. So that's the swap curve. So it's a comprehensive representation of all these different swaps, plain vanilla swaps of different maturities. Okay? Now, there's still another thing that's interesting, but there's only so much we can do this semester, which is there is a method, and it's illustrated in example 6.1 of this. There's an example 6.1 in this, 7.1 in this chapter that shows you how to make this transition between the swap curve and the zero curve. That means if you know what the swap curve is, you can get the zero curve, and if you know what the zero curve is, you can get the swap curve. But the example over there says if you know the swap curve, you can infer the zero curve. If you look at example 7.1, it looks so simple, right? But the underlying to explain why that's true is a little complex, and if it were an ordinary semester, I would have had a little extra time. But it's a little complicated to get through the details. But I want everyone to look at that example. It's a very simple example that illustrates how if you have the swap curve, you can get the zero curve. Why is that example so important? Because I told you the Federal Reserve posts the swap curve every day at the Federal Reserve website for free. That means anyone can read the swap curve. And if you know how to do example 7.1, from that swap curve, you can get the zero curve. And that's a much, much easier way than getting the zero curve like I showed you in chapter 4 from Treasury bond prices. Do you follow? But of course, all of these have to match up. They won't quite match up, and there'll be some arbitrage opportunities. So there's essentially, zillions of ways to arbitrage over here. Anyway, so let me get rid of this. That's just a side issue. A very important issue, but let me get rid of that because I'm going to need the space. Okay. So we're back over here. Now what I want to do is, I want to show you how you use the plain vanilla swap from a hedging perspective. Okay, I gave you all the details. First, some qualitative details about how you use the plain vanilla swap to hedge risk when you expect volatility to change. Then I showed you how you use the plain vanilla swap depending on how you expect inflation to change. Now I'm going to show you how you use the plain vanilla swap from a hedging perspective. Okay, so let's look at this example. Now, what happens is every firm has some operation. So now we have to put this in a corporate finance environment, right? Every firm has some set of projects that they undertake, right? And they evaluate the NPV of the project and then determine whether it's positive and then make a determination to accept it or reject it. Okay. Now, once the decision to accept or reject the project is made, right, you have to make a decision on how to finance the project. So this is after the accept reject decision, and we go to the financing decision. So generally, how does one make the financing decision? For this, you have to go back to your 3403 clause. Okay, you remember your degree of operating leverage, degree of financial leverage, and degree of combined leverage? Okay, that particular chapter on degree of operating leverage and degree of financial leverage was to illustrate what? And this is the way I used to teach 3403. I don't know who taught it to you guys, but anyway, the thing is, those are metrics that tell us what your operational risk is and what your financing risk is. Okay, quite simply, it's this. So I'm going to explain degree of, what we're concerned is degree of financial leverage, but let me explain what degree of operating leverage is. And this is the ratio we calculate from the top part of the income statement. And we ask whether it's too high or too low. But let me tell you why we did that calculation. The degree of operating leverage measures the business risk of the project. That means it measures the risk of the project after you decide to undertake it, and it measures the risk based on how you decided to implement the project. So let me explain that. So, suppose I started out a restaurant. That's a burger restaurant. Okay? Oh, actually, let me go back to a slightly different example. Let me go back to my traveling salesman, the vacuum cleaner salesman example. Okay, so I decide to start out a new business, right? And my new business is selling Kirby vacuum cleaners. And I need to hire some people, okay? I've done the NPV calculation and it's positive, and I decided to undertake the project. Now I have to decide how, now I'm implementing the project, so I'm hiring some people, and I have to make a determination as to what type of contract I'm going to write with them. And one type of contract is where I give them a $40,000 salary plus healthcare benefits and 10% of each vacuum cleaner that they sell, the price of each vacuum cleaner they sell. On the other side, I give them no fixed salary, no healthcare benefits, but 30% of each vacuum cleaner they sell. Now, I want you to look at those two contracts. In the first contract, right, I have a fixed cost, which is the salary, and a variable cost, which is 10% of each vacuum cleaner they sell. Notice I have to pay them $40,000 even if they don't sell a single vacuum cleaner. Is that clear? So you can think about that $40,000 as a fixed cost and 10% of each vacuum cleaner as a variable cost. In the second example, I have no fixed costs, but I have high variable costs. It's 30% of each vacuum cleaner that I sell. Now, I want you to look at this, the risk, the operational risk to the company. What happens if the number of vacuum cleaners I sell turns out to be less than the target amount, right? I'm generating very little in sales. I'm not paying these guys much commission because they only get 10%. But I'm not generating enough revenue to cover the fixed payment of $40,000 a year salary and plus healthcare benefits. So in that environment, what risk have I imposed on the firm? Pretty high, right? On the flip side, look at my other contract where I don't promise to pay you any fixed salary or healthcare benefits, but 30% of each vacuum cleaner. Now, if you begin to sell less than my targeted number of vacuum cleaners, well, is it a problem for me? If you don't sell even a single vacuum cleaner, I don't have to pay you anything. So what is the operational risk to me? Much lower. Okay, so the bottom line is this: when you're operationalizing the project, you have to manage the business risk, the operating risk of the project, and the way you manage it is as follows. What this example illustrates is you can lower the risk by having less fixed costs and high variable costs. If you have high fixed costs and low variable costs, your operational risk is high, right? So generally you want to manage your risk by making, and you'll find these big firms, right, like IBM and others, instead of hiring people to work on a salaried basis, they'll hire independent contractors to do jobs for them. So the independent contractor only gets paid when there's a project and when IBM gets paid on the project. And if there's no contract, the independent contractor never gets a call and IBM never has to pay them and cover the healthcare benefits. Okay, so this is quite a big thing that's employed by even large businesses. Okay, so that's the operational, that's what degree of operating leverage means. Now there's another part to this, which is degree of financial leverage. That's calculated from the bottom part of the income statement. Now, degree of financial leverage measures your financing risk. So what I mean by that is this. Suppose I undertake a project, right? And I'm expecting cash flows to come, or no cash flows, or cash flows in the first 2 or 3 years, no cash flows. And then, because you have to develop the market and stuff like that, and then cash flows to rise after that. Okay, suppose I take out a loan, right, which requires a high interest payment from day 0, when my firm is not generating any net positive profits or cash flow, right? What happens in those early years if I don't generate enough cash flow to cover my interest payments? You're in trouble, right? You can be dragged into bankruptcy courts and you could lose the firm even before you get started. Okay, another example of this is, suppose it's a 10-year project, but the bank tells me, look, we can't give you a 10-year loan, but we'll give you a 1-year loan and you can refinance it after 1 year. Okay, so it's a 10-year project where you take out a 1-year loan. Look what happens. If after the first year the bank finds out that you're not doing very well, will they refinance the loan? They won't. Okay, if you can't refinance the loan, the entire amount is due. What does that do to your project? You're in trouble. So to manage the financing risk, what you'll tell the bank is, look, this is a 10-year project. I want a 10-year loan. So that means I want my financing to coincide with my operations, right? If my cash flows from my operations are going to be low in the early years and high in the later years, I want a variable rate interest payment scheme where I'm allowed to make lower interest payments in the earlier years and higher interest payments in later years. The bottom line is you want to structure your financing and your obligations associated with that financing, that is your interest payments, to match the cash flows you're expecting from your project. If you don't match them, then you increase the degree of financial leverage or your financing risk. Okay? So the point over here is the project characteristics will determine the financing, the type of financing you would like. So you can see in a corporate finance framework, right? The nature of the project will push you in a particular direction of what type of financing to get. Okay, with that in mind, let's come back to this. Okay, so what we have is, now I don't want you to look at the swap. I'm going to build out on this. Let's look at Microsoft first. Microsoft has, let's assume that Microsoft has, manufactures chips and its sales depends on the business cycle. So if the business cycle is good, we're on the upside of the business cycle, everybody has a job, everyone has a lot of money, everyone's spending extra money on that extra computer, extra game, extra whatever that requires computer chips. So when the economy does well, its sales are good. But when the economy does poorly, People scale back on that, just covering their food expenses, and so their sales go down. So what happens is Microsoft's revenue is tied to the business cycle. So let's assume that. Now, what type of financing would Microsoft like in that situation? Right? Notice, if the business cycle is on the upswing, what will the Federal Reserve do? It would raise interest rates. So, while your revenues might go up, interest rates would go up, right? But what happens if you're on the downside of the business cycle? Your revenue goes down, but the Federal Reserve also lowers interest rates. So if you had a variable rate loan, the interest payments on your loan would also go down. So if your cash flows are tied to the business cycle, then you would prefer a variable rate loan, because the variable rate matches the business cycle, and when the business does well, you get a lot of cash flows, you can afford to make higher interest payments. And the reason you're willing to do that, if the business cycle goes into the tank, your cash flows are going to go into the tank, right? But your interest payments will also go down, and therefore you'll be able to survive that. In other words, there won't be any financial risk. So this pattern reduces your financial risk or your degree of financial leverage. So based on the nature of Intel's project, I'm going to write over here what it prefers. It prefers variable rate financing. Remember, what I have over here is based on the nature of the project. Okay, now Microsoft has a good steady cash flow from its operating system and its Office products and from its cloud computing. And usually we assume that those cash flows are not sensitive to the business cycle. So they're more steady. Whether the economy goes up or down, they collect a nice revenue stream. Okay? So if it wanted to finance projects, what type of financing would it take? It would prefer fixed rate financing. Why fixed? Because the cash flows to its profits are steady. Okay? Now, so this is their preferences at each corner. Now, each of these will go to the market to determine, they'll go to the investment bank and they'll try and figure out what the investment bank is going to offer or tells them is available, right, in terms of fixed rate financing and variable rate financing. Okay, now the fixed rate financing could be some fixed number. The variable rate financing will be LIBOR plus a spread. Okay, so suppose it's Microsoft turn. And the investment bank tells Microsoft, look, you can get a 5% fixed, or the LIBOR rate is 4 and the spread will be 4 plus 2. Say we have a 2% spread. So Microsoft has to determine, should I go with the fixed rate 5 or do I go with the variable rate, which is the LIBOR of 4 plus a spread of 2, 6. So Microsoft has to make a tough choice over here. Which is better financing, right? That means, where is the market offering me the most favorable terms? It knows what it wants. It wants variable rate financing, but it has to determine where the market offers the most favorable terms. Now, how one determines where the market offers the most favorable terms, I'm going to do that analysis a little later in this chapter. But for now, let's assume, based on a cursory examination of the terms, that the market is offering Intel more favorable terms on fixed rate financing. Okay? Now, so let's assume that fixed rate financing is 5.2%. So Intel can borrow 100 million and it will pay 5.2%. Let's suppose that's the interest rate. Okay, notice why I put this in blue. The term in blue represents the cash flows to the money it's borrowed. It's issued $100 million worth of debt. So 100 million has come in. Okay, my arrow convention is very important. Arrows pointing into the firm correspond to money coming into the firm. Arrows pointing out of the firm correspond to money going out of the firm. So this 5 pointing towards Intel means Intel receives it. From Microsoft's point of view, the 5 pointing out means Microsoft is paying it. And similarly for LIBOR. So these arrows represent the cash flows to the bond that Intel issues. It receives 100 million from the issuance of the bond and pays 5.2%. Now, remember what I said. Intel prefers variable, right? But the market is offering more favorable terms on fixed. So what should Intel do? Okay, the answer is always the same. Intel will always go, or any firm should always go where you get the most favorable terms, whether you want it or not, whether it matches up with your project or not. Okay, so in this case, fixed offers the most favorable terms. Now, if variable offered the most favorable terms, you would take variable. And is variable what you want? You want, you're happy. Do you follow? But right now we're considering the case where fixed offers the most favorable terms. But is fixed what you want? No, it's not what you want. You want variable. Okay, so now you start scratching your head. Dr. R said you always go where the market offers the most favorable terms. So you could do that. Now, let's look at this from, okay. Now let's look at this from Microsoft's point of view. Suppose Microsoft also goes to the market and it has to borrow $100 million and it's trying to figure out where the market offers the most favorable terms. Okay, so for Microsoft, we assume it'll issue $100 million worth of debt. And we assume that the market offers most favorable terms on variable, which is LIBOR. Suppose it's offered LIBOR plus 0.1%. Okay, so now, again, Microsoft gets the most favorable terms on LIBOR, but is that what it wants? It wants fixed. So neither one of these guys are happy. They both, now remember, I'm not saying that Intel and Microsoft went to the market at the same time. They could have gone to the markets at different times, and then they meet up, and now they want to change the characteristics of their cash flows. Okay, so now what happens is each of these guys, right, have taken the terms, the most favorable terms offered by the market for the debt they issued. However, neither one of them is happy with the cash flows associated with their debt because it doesn't match up the characteristics of their project. So then what they do is, to get what they want, this is where you get the most favorable terms. It's not what you want. To convert this to what you want, right, you execute the swap. So now, on Microsoft's balance sheet, what it will have is, it'll have two instruments. It will have a debt instrument with a fixed rate of 5.2, and it would have a derivative, which is a swap with these terms. It'll have two instruments on its balance sheet. But let's look at the net effect of these two instruments. And to determine that net effect, what I need to do is draw a circle around all these cash flows around Intel. Let's try another pen. Okay. Okay, now what we have to do is, we have to ask on net, what is the effect of holding the bond plus having the swap? We have to net out all these cash flows from Intel's point of view. First of all, there's 100 million coming in. So that 100 million remains. Okay, now there are three interest rate arrows, right? There are two fixed and one variable. So I can net out the two fixed. There's 5 coming in, 5.2 going out. So the net effect of that is 0.2 going out. And then 0.2 going out, and there's a LIBOR going out. So the net effect of that is LIBOR plus 0.2 going out. So the green represents the net of the bond it issued, where these were the most favorable terms, and the swap it got into, and the net of those two is this. Now, is this what it wants? Yes. Okay, now this is very important, this netting out effect, because say you get an auditor to assess the risk of Intel, and the auditor hasn't taken my derivatives class, right? He'll see two items on the balance sheet. He'll see a fixed rate debt. What will he conclude? The risk of this compared to your cash flows, which are variable, is high, right? Because your project cash flows are variable, your payments on the debt are fixed. What happens if your cash flows fall and you can't meet your debt payments? You're in trouble. So the risk is high. Then the auditor says, okay, what is this? This is a swap. It's a derivative. Wasn't the derivative blamed for the housing crisis? Well, the risk must be high. So now you have two items on your balance sheet that have high risk. So what's your risk? What did I tell you earlier? The auditor concludes it's too high. Now, but actually, what is the net effect of these two on your balance sheet? If I net it out, it's this. And if you ask, what's the net risk of this compared to your cash flows? What would you say your risk is? Low. Okay? The same thing we can do to Microsoft. We net out the cash flows. Remember, there are 4 arrows, 1, 2, 3, 4, going in and out of Microsoft. First, there's a 100 million coming in. That's the debt amount. And there are 3 arrows over here. There are 2 LIBOR. So we can net out the LIBOR. There's LIBOR coming in, LIBOR plus 0.1 going out. What's the net effect of that? 0.1 going out. Remember, this LIBOR coming in and this LIBOR going out cancel out, and you get 0.1 going out. And there's a 5 going out over there. So the total amount is 5.1 going out. So from Microsoft's point of view, the net effect of this, both individually would look risky, but the net effect is this, and is the net effect lined up with what it wants in terms of the cash flows expected for its project. It matches up well. So again, so what you're doing over here, you can see, you're going where the market offers the most favorable terms, and then you execute a swap to manage the risk associated with that. And from a corporate finance framework, you get the most favorable financing terms, plus you manage the risk of the project, both. Are we okay with that? Okay, now this particular swap term doesn't end over here. There's one more step, right? Because Microsoft and Intel usually don't meet face to face, right? Microsoft and Intel don't meet face to face. It's mediated by an investment banker. Okay, now, so let's put in the investment banker over here. We have an investment, banker, I'll put banker. Okay, and the banker brings the counterparties together. And so the banker is going to want some commission for their service. So let's assume, okay, now this, let's assume that the banker wants 3 basis points of all cash flows going through. 3 basis points. So what that means is, we're going to assume that both Intel and Microsoft is going to give up 1.5 basis points of the cash flows to the banker. So when Microsoft pays 5, what we're going to say is 5 is not enough. It has to pay 5 plus 0.15%. That is 3 basis points divided by 2. The investment banker wants 3 basis points. Divided by 2, 3 basis points is 0.03 of a percentage point, is 0.15. Okay, so Microsoft pays 5, but an extra 0.015% to cover the commission that this fellow wants. And Intel won't receive 5, but it'll receive a 4.985%. Right? So Microsoft pays 5 plus 0.015, which is equal to 5.015, and Intel receives 5 minus 0.015, which is 4.985%. Okay, so now we've put in the banker and we cancel this out, and that completely defines the swap now. So the swap is a 3-year swap, 100 million face value, 3-year swap, and these are the cash flows. Microsoft pays 5.015, Intel receives 4.985, and LIBOR goes all the way through. Okay, so that completely defines the terms of a plain vanilla swap. Okay, so what we're going to do is there are a couple of other swaps we're going to look at, but we're going to take a break over here for now, and we'll continue this lecture a little later.